Good evening. Tonight, let's talk about the American financial system. The American economy undergoes boom and bust cycles. The dot-com bust was a notable one, but the mother of all busts in our lifetime was in 2008, better known as the mortgage crisis of 2008. Its source can be traced back to 1999 when the then President Bill Clinton signed into law the Financial Service Modernization Act, which eased regulatory restrictions allowing banks, insurance companies, and investment institutions to merge. The American bankers had a free hand in merging for the first time since 1932. This led to anti-competition practices in which small banks were effectively outcompeted by big banks. To put the small banks out of business, the big banks bought out the small banks and gutted them by selling off their assets, effectively closing them down. This resulted in big banks like Bank of America and JP Morgan becoming bigger and powerful, hence monopolizing the American financial system. Banks are largely categorized as commercial banks, investment banks, and the central bank. Commercial banks offer traditional services like a checking account, savings account, loans, mortgages, and other financial services to the general public. They are collectively called retail banks. Investment banks help businesses in raising capital through various means like issuing stocks and bonds, advising on mergers and acquisitions, and providing investment management services. Central banks, on the other hand, regulate the country's financial system. They manage money supply and implement monetary policies that ensure economic stability. They also act as a last resort to lending money to the commercial banks. The Manhattan in New York City has the largest concentration of these banks, collectively called the Main Street. The presence of the New York Stock Exchange in Wall Street make Manhattan the hub for all financial wizardry, attracting the finest in financial activities and creativity. The American financial sector employs a very large number of people who are tirelessly working on creating all sorts of financial products and selling them in the financial market. The old age problem with the banking system is how to maximize profit while reducing or even better, eliminating the financial risk. In an ideal setting, a risky deal has the greatest reward due to reduced competition. For example, if a bank underwrites a loan and the loanee fails to pay, the bank is at risk of losing the money. To reduce the risk, they could keep the ownership of the title of your property or car as a collateral until you pay it off. If you default, they sell off the property and it clears off your loan balance. But what if the property value drops below what you owe? The bank will have to accept a haircut and take less than ideal while they dispose of your property. Because of this, bank could only issue loans to a person who was guaranteed to pay. This really squeezed their margins since not everyone could qualify for a loan. So in the early 90s, some financial geniuses came up with an idea of insuring a loan against default such that a bank buys an insurance policy against a loan such in that if you default, the insurance company will pay the bank. This kind of insurance is called the credit default swap. In the next video, I'll discuss in details the credit default swap and how it got one of the Wall Street insurance giant AIG into serious financial trouble. I'll also discuss the financial products like derivatives and collateralized debt obligations, that is the CDO. I'll also talk about spreads and leverage and the predatory lending practices. See how they almost broke down the world's financial system. We will see the role of the Federal Reserve and the US Congress in jumpstarting and stabilizing the economy and the tools they had employed in doing so. Finally, we will see what the banks did instead of unfreezing the credit market and lending that taxpayer bailout money to the public. See you in the next video.